Hey, everybody, welcome back to another episode of the Growth Capital Podcast. I am your host, Justin Dixon, and today we've got Brandon Ball on the podcast. He is the partner and CFO at Blue Diamond Capital, which is a single family office in Provo, Utah. Interesting episode because we talk a little bit about the differences between family offices, private equity firms, venture capital firms, how they think about investments, timelines, et cetera. We dig into a lot around how a single family office gets started. We talked a lot about how they think about diversification outside of just investing in real estate. They invest in private equity. They did some venture stuff as well. And then we round the conversation off with their philanthropic efforts and kind of why the family wants to really give back some of the profits that they generate from the business. So I think we'll get a lot out of this episode. So let's get Brandon on the pod. Interested in hearing conversations with private equity leaders, CEOs of private equity-backed companies, and startup entrepreneurs where they share their stories about their career journeys, starting, investing in, and scaling successful businesses, and the important role that having the right talent plays in building a successful business, then you are in the right place. Welcome back to another episode of the Growth Capital Podcast. Here's your host, Justin Dixon. All right, Brandon, welcome to the podcast. Thank you for being a guest.
Thanks for having me. It's great.
Awesome. Well, let's jump right in. Maybe give the audience, those folks that are watching and listening this, a little bit of an overview of who you are, where you are, and what you're up to right now.
Right on. Okay. My name is Brandon Ball. I'm with Blue Diamond Capital. We are a private investment management company. Our origins are in a family office. I'm here in Provo, Utah. I'm from West Jordan, Utah. Graduated from BYU in 2007. Did accounting, so I'm a CPA, and took two stops, one at KPMG out of school, another at a company called backcountry.com based in Park City. And I've actually been with Blue Diamond for 13 years next month. So been here a while and been through all the ups and downs and fun stuff of various investment management goes. So the wins and the losses.
Yeah. Well, I guess give us a little bit of kind of like, why did you join Blue Diamond? And then maybe talk a little bit about some of the nuances that you've seen over the last 13 years, because obviously you lived through COVID, you've lived through some other kind of market cycles. So, as a CFO of a family office, I'm curious what you've seen and the differences of the stops along the way, so to speak.
Yes, of course. Okay. In 2013, I joined as the controller and just had an opportunity. A friend referred me to the business for an interview. He actually had the job offer on the table himself, decided to pass. I came in and interviewed and got the job offer that afternoon and said yes. So that was fortuitous at the time for me. I did not know what was laying ahead of me.
But that's a nice friend to not accept the job and then say, here you go.
That's right. That's right. We had talked about it, and he was in accounting himself. He was still at the Big Four at the time and was about to be promoted. And so he was weighing whether he waited around and accepted the promotion or took this job, and ended up waiting around to take the promotion for on that point in time. So what have I seen? The key thing at the time coming into Blue Diamond was I knew consolidation. In a family office or any big investment firm, you have a ton of different investments. You have to pull all those things and roll them up together to make them make sense, of course, right? And a lot of things are in disparate industries and disparate ways of presenting the information. And you got to find a way or somebody that has the skills to pull something together and make it make sense holistically. So, on the Blue Diamond portfolio, we're very real estate driven. So hotels, apartments, home building, land development, other construction and real estate related businesses that we invested on a private equity type side. And then we do some venture and some just regular private equity and operating companies. So thinking of trying to view all that together, you got to pull it together, and different accounting rules, different presentation rules in your financials. One thing we do that's pretty interesting is guarantee a lot of debt. So when you are a large family office, a large balance sheet, you have a lot of stuff out there on loans, and the banks want to understand what is your risk structure and profile, whether or not they're going to grant a new loan for a new project development or new loan for any given business that needs money, right? So that's probably a key interesting item that I've seen over the years. We've definitely had projects go bad and had to work through significant issues on projects. I think we have a pretty good track record actually of doing well to get good resolutions out of tough situations. That's probably one of our calling cards. We've definitely won more than we've lost, though. So we've won a ton. We've had a ton of great experiences, great exits. One thing that's unique about a family office is they have a little more long-term horizon. So most of our exits have come naturally, right? They've come as somebody's brought us an offer. We weren't necessarily shopping it under a timeline. It was more operating the business. It was going well, and suddenly somebody came to the table to say, we want to buy. And we decide, sure, it's a good time to exit. Let's do it. A good example of that is 2021. For multifamily, we sold out of almost all of our apartments because the cap rates were so low. The valuations were so high. We were getting unsolicited offers on almost all of our apartments. We said yes to all of them and exited out. And now we're slowly building back up our multifamily portfolio over these past few years. So that's a good example.
Well, I know this isn't a real estate podcast, but I got my ass handed to me in 2021. We were investing in 2021. We were drinking the Kool-Aid, thinking that it was only going to continue to go up and to the right. And so, obviously you were a lot smarter than I was, some of the other folks that I was investing with. So I'm curious to start the conversation around family office, private equity, venture capital. A lot of the people that I work with, a lot of my clients on the recruiting side are private equity backed or venture capital backed. And so maybe talk a little about your experience in a family office. You talked about it a little bit there already, but how does the investment thesis and timeline differ from a private equity versus venture capital? Because you're still looking for, obviously, returns on your investment and you're managing the wealth of a family versus, other investors more so than not. So maybe just kind of break down family office, PE, VC, kind of how you think about it, and maybe some of the benefits as you see it being in your seat as a family office.
Yeah, great question. Okay. Well, the way I view family office versus PE or VC, I'm going to start with VC. The way I view VC is a group raising a fund of money and deploying a lot of small chunks in high risk deals and anticipating that they're going to lose on 9 out of 10 of them, maybe even 18 out of 20 of them, but the 1 or 2 of the group are going to go unicorn status and kill it and make up for all the others. And that's how I would generally look at VC. Is they're taking a ton of shots. They know it's a high risk, but the payoff is going to be some 50, 100x return that makes it all worth it. And there's plenty of good examples of that out there. Private equity is a little bit different. Most of it, in my response, would be usually they're raising a fund with a dedicated or focused industry investment type thesis. And more often than not, there's a timeline. Hey, we're going to raise a 7 to 10 year fund, go deploy the capital to make these earnings across this timeline. And the interesting thing about funds to me is as you get towards the end of life in the funds, they're not really motivated to do anything to help the business grow further. They're actually the reverse. They're motivated to sell off or kind of get out of it so they can kind of close it out, get the money back to the investors and move on to the next fund, right? And of course, if you've delivered a win, the investors are much more likely to come back to the table and put the money in for the next round. It's just that easy to get them to come in for the next round, where if you've struggled, then it's harder to raise that next round, right? So they're always maneuvering that way. The family office, each family is unique. So I can only speak for the family I've been working for the 13 years. But our founder is very entrepreneurial, wants to be involved in most businesses. As much as we can control, we are trying to negotiate partnership and involvement with any given business or project that we get involved in. We're not running the business on the day-to-day. We have a management team we believe in, and they go and execute. But we provide resources, a strong balance sheet. I mentioned guarantees a little bit earlier, some type of risk guarantee to provide lines of credit or new financing sources. And we help them, kind of break through maybe what barriers they might have only been able to achieve on their own as they're trying to grow as a founder. So those are a little bit different. We're not under the same timeline pressure at all. That's probably the biggest thing. It's very opportunistic. Hey, does this work or does it not? How are we feeling? What other opportunities do we have out there? We have the maneuverability and flexibility. Sometimes emotion can play into that. Sometimes there's a sense of, hey, I don't like this deal. It's just not working for me. And that might be on a new opportunity or an existing deal of a time to exit and get out. Because again, this is their money. We're responding to their wishes. We're presenting and trying to manage everything according to what they want and the long-term vision. But that's a little bit different, again, than the PE or VC. We've dabbled in those things. So we do have some play in PE and PE deals. And we did do some venture stuff for a while. We did not hit our unicorn on the venture stuff that we did so far. We have a few that are in play. I have a couple that I'm still optimistic can get there. But yeah, we didn't have the same experience in the VC side when we tried that for a set of years there. So
yeah. How does a family office kind of get started in the sense of, family office, you are employed by the family that, they've got a ton of money that instead of going to a big wealth advisory firm to manage all their wealth, they hire people or build a family office to kind of do that for them. So how does that kind of start? And I was reading the bio of the Bingham family of how was it the Yellow Pages or was some kind of phone directory that was started a long time ago and he sold it. And so obviously very successful. And instead of plunking his money into a wealth advisory firm, he decided to, build Blue Diamond Capital. Is that as simple as it is? Like that's how it kind of typically works?
Effectively, I'll tell you a little bit of the story here. Mark Bingham, the founder, he is turning 86 years old this year, still around, still comes in the office. He was in the office today. And he was running Phone Directories Company. They were an independent phone book from the 70s up through 2005 and 2006. And yes, I view operating businesses as a river. The money's churning, right? And most founders, not entrepreneurs, are reinvesting that money into the business. Their entire net worth is likely wrapped up into that business. And so as they go, suddenly they have a big exit. And that's what happened for the Binghams. They exited in 2005. They sold off the Canadian portion of their directories. And then that same group came back in 2006 and in 2007, and they sold off the U.S. component of their directory. So they had a good, solid, large business. Everybody listening today is thinking, what a great time to get out of the phone book business. And you are right. Late in 2007 is when the iPhone came out, and that is what changed the business. At the time, it was basically you're digitizing the phone book. You go online to yellowpages.com to look for plumber. Well, once the iPhone came out, now you have GPS, plumber near me, makes it easy. But that changed the whole component of the business. So their timing was immaculate. But to roll forward, yes, there's plenty of exits where now you have a lake. You have this massive money and you're trying to preserve it. How do you want to preserve it? And I know Mark Bingham's comment to Mike Bingham at the time was, I can't think of anything worse than going to the beach every day and opening my bank account and checking my money. That would be not the life for me. And it is for some people. Some people are like, oh, I made it. Hey, time to live the good life. And I'm just hanging out and doing whatever I want. What Mark wanted to do and what he continues to wants to do is invest in businesses and grow and find new opportunities. So he still has the entrepreneurial mindset. And there's clearly plenty of those out there. They decide to create a family office. Hey, we're going to do our own thing. We're going to go start moving and shaking and either get into tech and startups. We're going to get into real estate, which was our play. But most of them usually create some type of private wealth manager on the side. And we do have a public portfolio, so we work with our public portfolio manager to keep some liquidity base and keep that type of stuff working. But on a general sense, within our office, our focus is the direct private deals, and we go negotiate those. So I think that's what most family offices are doing. They pick an avenue, what they want to do, and they all do it just a little bit differently, and they have a little bit different decision structure and process. And I found that it's very unique every time I meet other family offices. But generally speaking, that's the setup. They come into the successful exit. What do we want to do going forward? Most are so driven. I know when I was a lot younger, I would have thought, hey, these guys made it. Why aren't they just on the beach? And why aren't they just on vacation full time? And almost every podcast you listen to, interview, you realize quickly, oh, these guys can't do that. They can be home for a week and they got to be doing something again. They're too bored. They realize life is about productivity, participating, playing the game, right? The game of business. There's a game here. There's a scoreboard. So all that is factors for sure. And it's what's different about a family office.
Yeah, I have a friend who had not as successful as an exit as a Bingham family, but he had an exit and, he's probably 40, late 40s or something like that. And he has been kind of semi-retired for a couple of years and, he still invests and now he's starting another business. He's like, I just can't stop the ideas that are coming into my brain. And now it's probably even more significant for the Bingham families. You have the capital to play the game and have it not, if you make a bad bet on a real estate deal or a venture capital deal, you're not, all your net worth is not resting on that one investment, right? You are spreading things around. So like, hey, I can take a little bit more of a gamble, or I can just invest in more entrepreneurs because I have a lot longer term view than a typical VC or private equity firm. I kind of want to talk a little about the diversification within the portfolio. You mentioned that kind of one of the core tenets is real estate. Were they involved in real estate before? Like, how did you pick real estate? And then what versions of real estate, what asset classes are you really kind of investing in and bullish on now that we're recording this in mid 2026?
Okay, great. Yes, they had a few pieces of land while they were still operating the phone directories company. So one particular project is up here in Heber City, Utah, and they got involved. Obviously, I mentioned the good timing of the exit before the iPhone. Bad timing heading into the great financial crisis on dealing with land and building, right? What got realized quickly was, hey, we can't move land. Land is not selling. Everybody's, foreclosed. What we can do, though, at least in Utah, was a growing state at the time. If you build a home, you can move the home. People are still buying homes for any given reason. They found two guys that had built just a couple homes the year before. They partnered with them on that piece of land up in Heber City and kind of naturally got involved in home building. So that was kind of the genesis there of both the land and real estate side and the home building. The year later, got involved with a developer out in Mark's hometown called Vernal, Utah, which is eastern Utah, on a couple projects. And that led into a partnership on a commercial development company, which was our hotels and apartments. So those two things kind of naturally flowed as opportunities came to them. And then we started building expertise in the real estate department, right? I'll call it. So, over time, we exited that first home builder. We're currently involved in 3 home builders, one in Utah, one in Idaho, and one in Tennessee. And then we have several commercial projects across several states with our developers, and we have several development partners. But So home building is probably our key tenant. We do a lot of land related to home building because you go buy the land, get it ready, get it prepped for the home builder to come take it over and develop homes on it in a year or two down the road, right? It's a little bit of a longer term play. You do wrap up money during that time period. We do like construction. We have some gas stations, a couple construction related industry businesses. So those things have kind of come over time as we've learned that business and the risks and the upsides and how the businesses operate. They all operate a little bit differently. The cash flows, the metrics, you got to kind of get yourself involved and get some expertise there to be able to execute and judge whether or not it's going to be a good deal going in.
And then as you think about the portfolio moving forward, you kind of have an interesting seat being the CFO. So you're not just an asset manager or an investment advisor kind of looking at one asset class. You kind of obviously see the full picture and how all the pieces of the puzzle fit together. How do you think about kind of moving forward, 2026 and beyond? Is the portfolio kind of continuing to have real estate be the lead tenant? Do you see changes in the risk profile or the different types of assets that you guys are really looking at as you move through the rest of this year and kind of into 2027?
Yeah, good. It's been tough in real estate the past couple of years. Since interest rates bumped in late 2022, it's actually been a dogfight since that time to get things out of the ground, to get new projects. We are still very bullish on, I'd say real estate as a class, but also on the operating companies. So home building, for example, is really an operating company. It's just real estate based. So we have a different expectation for any operating company we get involved with compared to a project. If you go look at a hotel or an apartment or an RV park or storage units, those are all projects and they have a little bit lower return metrics and expectations. They're pretty fixed. An apartment complex, for example, once it's pretty full, it usually kind of stays pretty stabilized. Where an operating company is about growth, and those are where your big wins come from, right? You're taking more risk, but obviously your big home runs are going to be from those operating companies executing and kind of hitting the hockey stick. I do believe a lot of timing has to come into those hockey sticks. The good examples are our first home builder I was talking about. Great management team, great execution, but also we were in Utah. We were in the right place at the right time. During that 10 years, there's been an explosive growth here. So hitting those locations, I don't know that you can definitely dial it. You can use all the data that you can find to try to estimate where the next growth spot's going to be. But we're still interested in all that stuff. We do still look at operating companies and opportunities on the periphery, so to speak. We did a roofing company, for example, earlier this year, a deal with a roofing company with a growth strategy. That's in the construction vertical. It's not a real estate, direct, but those type of things are kind of where we're looking and where we've migrated to, I'd say, the past 5 years. We migrated a little bit away from the VC stuff. We were doing that in the late teens into early 20s and I don't think we knew exactly with expertise what we were expecting going in. And again, we have a few that I'm still bullish on that will kind of get there, but we migrated away from those. Thought we are better skilled to use our money in the stuff that we know how to execute on or that we know the details. And that's where we're sticking kind of going forward.
Yeah. Let's talk about the private equity side and you getting involved in the deals, because a lot of times private equity will do a majority buyout of the founder or the ownership group because they want to have control. They want to have people on the board, et cetera, et cetera. Do you take that same, structural format with the kind of companies that you go in and support from more of a private equity lens standpoint? Are you buying majority control in these deals and then obviously putting people on the board to help kind of make sure that you have, your hands on the reins of the company so that you can correct it in the way that you want it to?
Yes, not always control. It depends on where the founder is and what is the right check size to allow the founder and the management team to go execute for growth, but then also allow them to, still have what they're looking for in their growth trajectory. More often than not, we're finding groups that are kind of in the nascent stages that have grown to a level that they can get to on their own and need some help. They're not looking to sell out. They're not looking for money off the table, so to speak, quite yet. They're still on their own growth and realize, hey, I still got to get there in another 5 to 10 years. We've been fortuitous in a few of those opportunities to partner with them at the right time, not always taking over controlling ownership, but a significant piece. And what we typically do is add in debt later. We'll add in subordinated debt. That does not dilute the founder, right? And so they still have their upside. We have a sufficient ownership chunk that gives us a good upside. We're in it for the upside too. But then we'll add some layers of subordinated debt, call it owner debt later, that provides us some cash flow. It's a fixed interest rate. So the management team and the ownership team still has their equity, non-dilutive, but they have the additional cash to continue their growth plan. And we have a balance sheet to go provide, again, opportunities for better growth and better lines of credit, that type of stuff, compared to what those owners could have originally got under their own metrics, right? They would have had a slower growth play. They're hitting a ceiling. We can burst them through that top. That's what's been our history.
And how do you find these companies? And then once you do find a company that is interested in taking on some equity partners, how do you compete or differentiate yourselves from a private equity group that may be shinier or more well known? Because obviously, most family offices try to stay a little bit under the radar from a branding perspective, right?
Yeah. You're right. We've stayed pretty under the radar. I think there's a lot of deals in Utah, at least, that we're involved in that most people don't have any idea that we're involved in, right? They're kind of surprised when they hear about that. So you're right on the under the radar part. I see plenty of opportunities come across our desk that are just like, I'm like, you guys are candidates for a big player, big shiny player, and not us, right? There's a relationship fit too. You meet somebody, whether through any type of referral or networking opportunity. We're not out there marketing, so everything is kind of personal referral, introductions, networking groups we're a part of. Those all come kind of naturally. And as we meet people and see opportunities, you can tell pretty quickly if they're going to be a fit for our style and our check size, right? We have our target check sizes that get into these deals, target size of companies. If I have somebody coming in saying we're worth $1 billion or $500 million, that's probably outside what we're trying to do to be involved, right? And to have some say. We might go participate, say it looks like a good deal, but we're not going to have any control. We're just along for the ride. Okay, maybe we'll do a small check size there. But generally speaking, the bigger players that, we're a decent size ourselves, but there's plenty of big players out there. And if they're interested, it's probably pretty easy to see which size an opportunity is going to go for.
Yeah. And when you guys do end up investing in a company, how often do the founders or the leadership team kind of come to you for advice, support? Because a lot of times founders or operators need capital to hit that next level of growth, but they also need access, they need advice, they need support. So how much of it is they come to you for the check and the money, or how often is it more like, hey, we want your money, but we also want your help, your brand, your support on, helping us get to that next level?
Absolutely. I hope for both. I hope it's both. I think our intent going in is that it's both. As we develop the relationship over time, that either improves or, and sometimes it does go the wrong way, right? And if a project's going wrong, we're trying to jump in and say, hey, we think you need to do this, this, or this. If they're not listening, it can create a divide. It really can. We try to provide resources beyond ourselves of, hey, we know this person, they've been successful in your industry. We'd love to connect you as a mentor. So we do try in our involvement to help all of our founders or any partner that we're involved with to have resources beyond ourselves, but we definitely want to be an open door, frequent contact, frequent informal contact that creates that good relationship going forward, that they feel like they can call anytime, or that we can get on the phone or go visit them anytime and hash out or discuss anything they need. It doesn't have to be necessarily just business, right? There's all types of advice that comes to mind. As you build a relationship with other people, you usually end up working outside of business parameters, getting to know their family, getting to know their spouse, all those type of things. Those build your trust too. And we really appreciate that, want to achieve that. You can't with everybody when you start getting too many people involved in the network. But on a whole, I'd say most of our key investments, we have really solid relationships. They come to us for good advice, good resources, and the check, of course.
Yeah. And then I know you're in Utah, the family's in Utah, and it sounds like you have a decent amount of investments in Utah. Are you kind of location agnostic when you look at different deals, or are you really trying to find deals in that kind of Utah, Colorado, upper part of the country, or not a requirement?
Not a requirement. I mentioned we have a home builder in Tennessee. We actually have an assisted living facility in Tennessee as well. So we have a couple deals outside of kind of the Intermountain West. Most deals, because of the nature of the referrals and the introductions, have been in the Intermountain West. So definitely that's the large majority, but we are location agnostic. We would go anywhere. We have frequent conversations with groups and introductions with people outside of Utah. So that's not a requirement by any means. We're actually involved with a group called Kiln. They're a co-working office group that's expanding pretty quickly. And they got some stuff down in Texas, Colorado, you mentioned, over in California. So, and up in Seattle. So we are trying to find opportunities with growth companies that are expanding beyond just the Intermountain West. The roofing company I just mentioned, they actually just finished an acquisition in Louisiana. So that's our first taste into Louisiana. And we have I don't know if you ever heard of Swig, but it's a drink, the soda company with the drive.
Okay.
And we're involved with them with a master franchisee in Indiana. So we do have stuff outside of the Intermountain West, but again, naturally, all those introductions came through Utah channels, and then it ended up being outside the state. Totally fine. That's not our target, but that's fine. We're agnostic.
Yeah. I probably should have asked this earlier on, but what is your kind of ideal kind of buy box for the private equity side? Obviously, real estate kind of fluctuates and depending on if it's a development deal or whatever. But when you're looking at companies to invest in, what is your kind of ideal buy box or stage of company and all of that?
Yeah, great question. That one is the hardest part in the family office, because I think it can change over time depending on what the family's looking at and how they're feeling about the industry, the markets, how bullish they are themselves. And when you bring a deal to the table, you might feel yourself, I might feel myself, hey, I'm bringing a stellar deal to investment committee. And they might say, not for us. And, I go back and say, hey, sorry, this one didn't work for us, even though I think it's a great deal. Generally speaking, on a group that's growing, obviously you want to see some type of growth metrics. We prefer a group that's in, I'll call it relatively early stage. They've been going for a few years. They probably maybe not aren't profitable, so to speak, but they have real good, strong revenue, a good growth projection, and whatever their strategy is that is going to provide good ongoing cash flows once they get over the hurdle of being operationally profitable. And then, of course, some type of future exit, even though that's really indeterminate, you still build it into your underwriting, usually on a 7 to 10 year time frame. So those type of things end up being the parameters of the buy box. It's more about the check sizes. We're usually, I'm going to call it low of 1, high of $10 million is kind of our general check, where you mentioned the big PEs earlier. They might say if it's less than 30 million, we're not even talking to you. So every group has their targets. We try to keep the check sizes more manageable. Then we usually are in a better position. We're always trying, admittedly, to negotiate better than typical LP returns, right? We're not coming in to be just a limited partner and hand you our check, and then you just kind of send us a dividend when it's ready. We're looking to be involved, looking to be your partner, looking to have communication more frequently than a quarterly newsletter through email. So it is a relationship, but lots of times we're identifying a company that's at the stage where our check is going to be meaningful, and we're going to be able to negotiate some of those extra terms.
Got it. I wanted to kind of talk a little bit about, because this was doing a little research, I didn't realize that there were kind of two entities under the Blue Diamond Capital. You've got this Blue Diamond Capital, which is kind of it seems like the core family office. And then you've got Blue Diamond Capital Investment Advisors, which obviously you're involved in both. We were talking a little bit off air before we started recording about family office exemptions and all this stuff. So maybe walk us through the evolution of the family office and then this investment advisory kind of shop.
Yeah, great question. We still are effectively operating as a family office. Kind of the day-to-day experience is no different than it ever has been in my 13 years here. However, in 2021, we reorganized the structure of the ownership of Blue Diamond Capital and realized that prior to that, we were operating under the family office exemption. And subsequent to that, we were no longer operating under the family office exemption. So once we realized that, we want to get compliant, we're doing the right thing. When we have raised special purpose vehicles for a given investment, sometimes we'll take the family and they'll participate in a chunk of an investment, but we have good terms. We'll go raise some funds from friends and family. We've done that under the Reg D private raised offerings, and those are all good. But what we realized was that we actually weren't operating under the family office exemption anymore, so we needed to get compliant for our own family due to the restructure. And a quick sidebar for that, for those that are interested in what it is if you're managing a family's money, making investment decisions, and the family's in charge, which they are, then you don't need to register. You don't have any compliance issues with the SEC. Now, if you are operating such that you no longer have the family in a controlling position to making those decisions, then that's outside the family office. That's a client relationship. Okay. And so if you're in a client relationship, you do need to have some registration depending on your size. And our size falls into that bucket where we need to get registered. So we do not hold it. Most RIAs are a private wealth management group that have public securities, and they're mostly trading stocks and bonds and public securities. And the stuff that we are focused on at Blue Diamond are private investments, right, that we've been talking about. And most of the RIAs are going to say, oh, those are alternative investments. And they'll direct some of their clients to those, but that's not their focus. Their focus is the public markets. It's completely reversed. So we are a little bit unique on the registered investment advisor side with our Blue Diamond Capital Investment Advisors. We have that out there. We don't market it. We really still are a family office with a handful of other friends and family clients from long-standing relationships. But our target is the private investments. We have relationships with public brokerages, public brokerage firms that still handle the chunk of the portfolio that is the public market, which we still have. But that's not us. We're not trading securities here in our office, and don't anticipate to do that in the future. So it's a very interesting thing. If you are operating a family office, anybody listening to this, do your research on how to qualify for the family office exemption, or find out if you're not. And again, once we realized we weren't, we got compliant as soon as I could get through all the paperwork. There's always a lot of paperwork involved, but other than that, we got ourselves up and going and feel really good now about where we're at.
And so the simple kind of, criteria is the ownership of the business that is doing the investing. So it's if the family still owns control of that business and you're an employee of that business or whatever, you're still a family office. But then if the ownership changes, then you are then a client kind of relationship.
Exactly. And our day-to-day hasn't changed at all. It was really for tax purposes that we restructured the office and inadvertently realized that, oh, well, now we have this other issue on the licensee side. So it's kind of funny how that worked out. We were trying to battle the tax side where the IRS was telling us to do one thing. We said, okay, we'll go do it. And so we restructured, and then we realized, okay, well, now we got to add this other layer. And, it just kind of adds a little bit of formalization. And that's probably for the good. In our meetings were a little bit more formal of signing off and following all these things that a lot of family offices are the Wild West, where they might not have their documentation of, oh yeah, we approved that investment back in 2015 or whatever. So, we've improved on all those aspects and try to be just a tad more formal, but the operational day-to-day is the same and the family's still in control. So that's totally fine.
Yeah. Do you have a target amount of capital, and I don't need specifics necessarily, but do you have a target amount of capital that you're trying to deploy each year, or a target number of deals you're trying to execute on? I know some family offices or private equity in general, they have a fund, they need to deploy that capital in a certain amount of time and all that fun stuff. Do you guys have that kind of pressure or target, or is it really, let's make sure we're being the best stewards of our money as we possibly can?
That is a great question. And the base answer is no. We don't have a target number of deals per year or even dollar amount. We kind of have a general sense as we head into each year. We have a budget. We do the roll up, the consolidation again of, hey, how do we expect every given partnership company or portfolio company, however you want to refer to it? Here's what we're expecting from these in the coming year as far as cash flows. And where's that going to put us? Right. And we actually, quick sidebar, we have a big commitment as a chunk of the profits from the company every year actually go into a private foundation that gets donated. Right. So that's probably our biggest overriding drive is what is our cash flow allocation into the foundation each year? And that gets sent out to the different donations that are approved each year through the private foundation. Mark B. and Deborah C. Bingham Foundation. You can find that on our website. Kind of a cool thing. As far as deployment, that's all based on what we're expecting in the coming year. Now, we almost every year organically have a exit of some sort that comes up that's usually not built into our budget. So we end up selling off a hotel or a business or something like that, has some excess cash flow. We'll look at that and figure out how to redeploy it based on opportunities. There's always plenty of opportunities coming in. Actually, it's kind of funny because I'll say this here on the podcast, like your timing is so essential. And this got to be to anybody, not just my group, any of these deals. You mentioned some of these private equities needing to deploy cash or being towards the end of life and having no cash. When you're out hunting for a deal, if you're an entrepreneur and you have a project, keep going, because a lot of it ends up being the timing of whether that group is in a position of, yep, we want to deploy some cash right now, or not. No, we're kind of hanging on right now. And so just keep going, because you'll find a group. If you have a good deal, again, I see plenty of good deals that I say no to, not because I don't like the deal. It's just our timing's bad. We're not deploying right now. We're already committed on the stuff, whatever. But there is no fixed, hey, we did 3 deals this year, now we're done. It's very much more as we see stuff and opportunities and kind of where we're at in our cash flow cycle.
And then I wanted to touch on a little bit on the philanthropic side. I saw that they opened or were planning a clinic up in Utah. I think that was supposed to open, I guess, a year or so ago. And I guess how much of I don't need specifics here, but like, how do they think about the profit and how does it obviously benefit the broader population, right? Because obviously when you have a lot of money, you are sometimes obligated or feel obligated to give back and all that fun stuff, especially if you didn't grow up, massively wealthy. You kind of want to inherently give back to the community that helped, kind of develop you and all that fun stuff. So how does the family kind of think about the philanthropic side of the firm as you think about investments and obviously having exits and things like that?
Oh, it's incredible. I'm glad you asked about that, because the Mark and Debbie are incredibly philanthropic. They've been amazing. They have given away several millions of dollars over the past 15 years. Primarily Utah State University and Utah Valley University have received massive donations. Several other private enterprises. Their primary goals are medical, educational, and wildlife. Mark's a big hunter. And I am not a hunter. What I learned starting working here is that hunters are the people that care the most about wildlife preservation. That kind of made me chuckle when I started learning that hunters are the people trying to preserve herds, be responsible on all that type of stuff. So that's kind of a sidebar. But on the philanthropy side, we did open the clinic back in January. There's a free clinic here in Provo. And we've organized it, set it up. They've done a great job. And they recruit volunteer doctors to come donate their hours. And people that are uninsured or underinsured can go there and get medical services without having to pay. And so we're trying to create a model there. Hopefully we can get enough ongoing donations to, basically support kind of as low of overhead as possible on the back end. and eventually maybe do more than just one. But for right now, we got one. We'll get a stabilizer over the next couple of years. It's great. And but they as a whole, we have a chunk of profits every year that goes into their foundation. Get tons of applications for grants and scholarships and donations each year. We have a whole board. They decide based on our budget how much they can give away each year. They make the commitments, and that's going. So that's an ongoing commitment that's going to be the future Blue Diamond Capital always, is to basically fund some of these profits. And kind of the whole point of the growth is to fund that and give back. To your point, they acknowledge they want to give back, do more good in the world. Our family in particular, Mark and Debbie, are way more frugal. And, I guess I'll call it, they live way below their means compared to most people of their wealth status, right? You wouldn't know meeting them. They manage and are part of this big wealth machine. So they've been very generous. And that is a key milestone, this clinic that you mentioned. So thanks for bringing that up, because it's a pretty cool thing. It's called the Bingham Family Clinic here in Provo, or Orem, right next door to Provo. So if you're around, come check it out.
Yeah, no, there's a book I think out there called The Millionaire Next Door. It's kind of like that person that doesn't flaunt their wealth, but just by talking to them that they've got some capital and all that fun stuff. I think that's the best kind of wealthy person that doesn't have to show it, to be able to also give back and donate and be philanthropic about everything. And yeah, I think that's awesome that they had that mindset. It sounds like from the beginning, it sounds like.
Yeah. And if you'll give me a second there, I do want to shout out Mike Bingham as well. He's been working with them since the phone directory's days. He's actually not related to Mark and Debbie, but he has been a major backer of the clinic with his own personal funds as well. He's been the machine driving this whole thing the whole way. So he's been their key employee. He's the managing partner of Blue Diamond Capital. I'm a partner. Been a partner since the 2021 restructure, but he's been amazing too. So just want to give him a quick sidebar.
Yeah, no, I think it's a good kind of part to end on is the high side of, sometimes you talk about private equity, it's all about the returns and how you're going to shrink their expenses and grow the revenues. And so, talking about philanthropic ventures is always a good way. So let's kind of transition to the final part of the episode here. And there's a 3-pack of questions that I ask every guest. The first question is, what's an influential book that had an influence in your life that you may recommend to the audience?
The book, and I had this ready based on our previous, it's called The End of the World is Just the Beginning, from Peter Zeihan. I read that book about 3 years ago. I still bring it up to people all the time, and it's focused on the unique aspects of the United States and why we're so geographically, politically, economically positioned to survive and thrive. So you mentioned, are you bullish? How do you look at the future? That book really has me feeling good about the future and the opportunity we have to be lucky as Americans to be here and operate in this country. There's always political divide. There's always issues. But honestly, we are well positioned and we're the best country in the world at everything that we're trying to do. And so it makes me kind of grateful. I bring it up to people all the time to go read that book and figure out why America is so great.
I had not heard about that, but I will have to check that out. Yeah, that sounds very fascinating. Very cool. Second question here. Favorite thing to do outside of work? You're not a hunter in Utah, so what do you do outside of the office?
Well, not last winter. We talked before we started here. I love skiing. I love skiing with my kids. I go up to Sundance Ski Resort. We go pretty much every week in the winter. Not this past winter, so hoping we can have a good winter this time. That's probably my favorite thing to do. Very low key. I'm not some acrobat doing flips off the slopes or anything, but just enjoying the day. You're outside on a great day and just cruising, man. It's a good time.
Yeah. Yeah, no, skiing. I grew up skiing, not the mountains of Colorado or Utah, back in Pennsylvania, which they're more hills than anything. But
hey, you know what? Riding down the hill is a fun thing to do. So that's what I enjoy right now.
That's exactly right. Awesome. Last question here, Brandon. What's your favorite vacation spot?
I'm going to give you 2 if you don't mind. My yearly vacation spot, I've had the opportunity to go to Lake Powell past few years. That's probably my number 1. If I could go there every year the rest of my life, I'd be a happy man. Lake Powell's in stress. Same with the low winter. The water issue is a real dire issue there. But it is a magical place. It is a very unique place in this entire world. The canyons, the water, really cool. I wanted to talk about really quick. It's called Pybus Point up in Alaska. I've been there 2 times. And that is a magical place as well. And if you ever have an opportunity to go any type of deep sea fishing or Alaskan fishing, anybody, I'd encourage you to get up there. It's just different once you get up there. I wasn't a fisher or hunter, but once I went there one time, I thought this is incredible. And I think about that a lot.
Interesting. I had not heard about either of those places. So that's always the benefit to being the host and asking these types of questions. I have a laundry list now of vacation spots and books that I need to tackle. So this has been, Brandon, this has been a lot of fun. I really appreciate the time. If people want to reach out to you, maybe they're a founder and they want to, bring in a family office to their core, or they just want to pick your brain about things, what's the best way to connect with you?
I'd probably say email brandonb@bluedicap.com. Go to our website, bluedicap, BLUEDICAP.com. I am on LinkedIn. I'm not super frequent on LinkedIn. So if you message me there, I'll probably see it within a week or two, but I'm not like a daily poster there. So just probably email or website, anything like that would probably be the best way to find me.
Awesome. We will put all the stuff in the show notes so it is easy to access. So Brandon, thank you again. I really appreciate your time and thank you for being a guest on the pod.
Thank you. It was a pleasure.
I hope you found at least one actionable insight from this episode of the Growth Capital Podcast, your one-stop shop for insights from private equity leaders, CEOs, and startup entrepreneurs on starting, investing in, and scaling successful businesses, as well as the role having the right talent plays in growing a successful business. It would be greatly appreciated if you would rate and review this podcast. And if you're watching on YouTube, please like and subscribe and drop us a comment so we can expand the audience of this podcast. Thank you for all your support, and don't forget about upcoming episodes dropping every Tuesday.